Great guys, let's turn it up another notch. We do Mr. Maccy. Assume a VAT rate of 14%. Very important that you read it and that you apply it, otherwise your whole answer is incorrect. Mr. Maccy owns a reputable spare parts business called Dumpy Spares in Potch. Dumpy is a registered value-added tax vendor and sells most of his merchandise on a cash basis. Inventory is being managed on a perpetual basis, important, and a net profit margin of 25% on the selling price of goods is maintained. So let's just add our profit formula here so that we know exactly what we're talking about. It is 25% on the selling price. So our formula is cost plus profit equals selling price. So if we're going to do this now, we will say, well, it is 25%, but on the selling price. So now the selling price becomes 100. Profit equals 25% on the selling price. So that must be the 25 then. You agree? 25 divided by 100. If that is 25, then it means that the cost price must have been 75. Just put it on one line for us. So then it is cost price 75, 20 plus 25 equals 100. Assume that all amounts include VAT, except where otherwise indicated. All transactions are concluded with other VAT vendors, except where specifically indicated otherwise. You can assume that Dumpy never had to make use of a bank overdraft in the past. Why that sentence? So that you treat your bank as an asset. Details of the transactions conducted in January were as follows and what is required from us. Analyze the above-mentioned transactions for January in terms of the accounting equation by making use of the following format. Now again, this is a slightly different format. If you do not follow this format in a test or exam, your question will not be marked. The date, account description, equity, assets and liabilities. So if we have a look there, we said, well, obviously at this point of time, there was equity of 300,000, assets of 450,000, liabilities of 150,000. Assets less liabilities equals equity, so it absolutely balances. Great, so let's start with the transactions for the month of January. On 5 January, Dumpy purchased spare parts from Tuffy with a normal invoice value of 51,300. Tuffy gave Dumpy a trade discount of 10% as a result of the large order placed, and Dumpy paid cash on the delivery of the goods. So what did Dumpy pay? Not 51,300, it's an invoice value, so it will include that. He paid 90% of the normal invoice value. So 51,300 times 90% gives us 46,170. If we then remove the VAT exclusive cost price of the goods was 46,170 divided by 1.14 equals 40,500. So inventory, statement of financial position debit under assets, it would have increased with 40,500. VAT input would have been debited against assets, 5670, 14% of 40,500, and bank, because I paid cash for it, statement of financial position credit with a total amount of the invoice, 46,170. On 7 January, Dumpy sold spare parts to Scruffy for cash to the value of 2280. It was for cash. Scruffy is not a registered VAT vendor. Now we've seen that we are a perpetual inventory system, so that means that with every sales transaction we have to adjust our inventory record as well. Does it matter whether Scruffy is a registered VAT vendor? It doesn't, because he's a customer. It is a fact that Mr. Maccy is, and Mr. Maccy then has to, or Dumpy, who's this? Mr. Maccy Dumpy. Dumpy is the business name. So Dumpy is a VAT vendor. So therefore that 2280 will be subject to VAT. So bank assets will increase with 2280. Sales, statement of profit or loss, will be credited with a VAT exclusive amount, 2000, and VAT output will increase liabilities with 218. Now we have to determine what is the cost price of goods sold. And here's our profit formula. Just see if I can do something about this. 75 plus 25 equals 100. So our cost price, we have the selling price. There is our selling price. Here it is, 2,000 Rand. And 2,000 Rand times 75 divided by 100, i.e. 75%, will give us 1,500. So cost of sales is an expense item. It will reduce our equity, but it will also reduce our inventory with an amount of 1,500. Mr. Maccy is a keen animal lover and donated 1026 to the SPCA to upgrade the facilities on 11 January. There's no VAT on donations, so therefore donations, which is an expense account, statement of profit or loss debit, will reduce equity with a full amount of 1026, and bank would be statement of financial position will reduce our assets with 1026. On 15 January, Dumpy sold spare parts to Needy panel beaters. The normal invoice value of the spares was 11,856, and Needy requested to pay for the purchase spares in 2 installments. The first on the date of the purchase, and the second will be made on 1 February 2017, so in the next month. Dumpy agreed to the terms but charged Needy 5% more than this normal selling price as a result of the time delay in receiving the outstanding amount. Needy took the spares and paid for 50% of the invoice on 15 January. Okay, so the normal invoice price is 11,856. We are going to charge him 5% more. So we are going to charge him 11,856 times 1.15 equals 12,488. That is our selling price. Now 50% of this he's going to pay upfront, 6244.40. The other 6244, there's a mistake, it's 6244. That will then be paid in the next month. So we will have to raise a debtor for that. So bank will be debited with the first 50% of 6244. Just make sure which one is the one. Yeah, it is 6244. And debtors is going to be debited with the other 6244. Our sales equity is going to be credited, statement of profit or loss, with a VAT exclusive amount. So 12,488 divided by 1.14, that will give us our 10,920, which is our sales amount. And the VAT that was included in this invoice was 10,920 times 14% equals 1528 to 1529. Well, I've used 1528, otherwise my journal entry would not have been in balance. So VAT output liabilities will increase with 1528. Now we have to adjust our inventory record. And what is very important that you realize that when we're going to work out the cost price of goods sold, we have to work on the normal selling price. So the normal invoice value was 11,856. We can only apply our profit formula if it is normal prices. This is our normal markup percentage. So therefore, the normal selling price inclusive of VAT was 11,856. We have to take out the VAT first. So therefore, the normal selling price is 10,400. Based on the 10,400, we can apply our profit formula. So 75 divided by 100 multiplied by 10,400 gives us then 7,800. So cost of sales, statement of profit or loss, 7,800. Inventory, statement of financial position, which will decrease our assets, 7,800 Rand. The car of Mr. Mackey's son Donald broke down and Mr. Mackey took spare parts with a cost price of R1,300 exclusive of VAT on 21 January out of the storeroom to fix the car. So obviously his inventory has decreased. They gave us the cost price of that inventory items. Guys, if they gave us a selling price, you first had to convert it to the cost price. So but they gave us the cost price, so we know exactly what to adjust against inventory, R1,300. But remember when we bought those inventory items, we claimed VAT from the receiver of revenue. And the receiver of revenue allowed you to claim the output VAT would have been more than what you would have claimed when you purchased the stock. So therefore, you have to pay him his VAT back. Okay, so we are going to credit our inventory with a cost price. So our asset inventory is going to be credited with 1,300, the cost price. The original VAT that you claimed on the 1,300 Rand was 14% of 1,300, which is 182 Rand. So now we're going to pay VAT output on that, which is going to increase our liabilities with 182 Rand. The sum total of these two is going to be the value of our drawings. So we're going to debit drawings with a 1482. Please note statement of financial position. Equity is going to reduce with 1482. Assets is going to reduce with 1,300 and liabilities is going to increase with 182 Rand. An old computer belonging to Dumpy with no book value. So no book value, it means it was in the books for zero. Now whilst I'm talking about that, at school they teach you this silly rule that you cannot write off an asset to zero. Guys, of course you can. The only requirement is that that asset must still appear in your asset register, but also at a zero value. So don't come with that rubbish of 1 Rand to me, it doesn't work. You can write it down to zero as long as that item still appears in your asset register. An old computer with no book value, so zero book value, was sold on 24 January to Alfred, store manager, for an amount of 399 Rand. Alfred paid cash for the computer. So we received 399 Rand. When we bought that computer originally, we claimed VAT on that. So the receiver of revenue says, now that you sell that, included in the proceeds is my 15% VAT that you have to pay over to me. So it was in my books at a zero value. So we received that in the bank, assets increase with 399 Rand. The VAT exclusive amount belongs to the entity. And because the book value was zero, the full VAT exclusive amount will constitute a profit on the sale of the computer, statement of profit or loss, which will increase equity with 350 Rand. The 14% VAT on the 350 Rand, i.e. the 49 Rand, I have to pay over to the receiver of revenue as VAT output. So statement of financial position on the liability side, 49 Rand. Guys, I apologize for the dogs who's barking. I tried to shout without putting this video on. Okay, then Chancellor Auto Body Repairs took spares to the value of 2508 from Dumpy in October on credit. Okay, so that was a different month. We are actually busy with January. Payment was made in his account in the same month, but it turned out that Chancellor had insufficient funds in the bank account. So this was in October, not this month. And the payment was returned. Dumpy tried to collect the money from Chancellor since October, but with no success. Mr. Mackey decided on 26 January to write off the debt as uncollectible or unrecoverable. So what is the outstanding amount? 2508. Remember when the initial sales transaction took place, what happened? We debited the debtors control account, Chancellor's account with 2508. We credited sales with a VAT exclusive amount, and we have paid over VAT output on that sales transaction to the receiver. But we never collected the VAT because the guy never paid us. Therefore, the receiver of revenue allows you to claim the VAT back now. Now also remember the golden rule that no income or expense item in the income statement will ever include VAT. So obviously we have to clear out the debtors account. So we are going to credit the debtors account statement of financial position with 2508, which is going to be a reduction of an asset. The VAT exclusive amount we are going to write off as an expense account credit losses. Guys, not bad debts. If you're going to write down bad debts, I will mark it wrong, because there is no such an account as a bad debt account. It's a credit losses account. It's the same thing, but we call it something different. Credit losses, statement of profit loss, it's expense, so it will reduce our equity with 2,200 Rand. And then the VAT that we're going to claim back, you can either treat that as VAT input, which is going to be a reduction of our liability, or that 308 you could have put here as an increase of our assets. So either or an increase of assets or a reduction in liabilities. I would have marked both of them correct. It is VAT input. Why is it VAT input? Because the credit losses is an expense, and we can claim VAT on expenses, and that we call VAT input. On 30 January, Dumpy paid 11,400 Rand in respect of the rental of the premises for the month of February. So that is a prepaid expense. Now, what is the first step that we do in accounting? We take out the VAT. So what happened here? The receiver of revenue said, have you received a tax invoice? The answer is yes, but it is a tax invoice for the month of February. The receiver of revenue says, okay, well, I accept that, but did cash flow take place? I said yes. He says, when? I said on 30 January. Then the receiver says, I'm a reasonable guy. Because you've already paid for the rent for February, I will allow you to claim the VAT now. So that is definitely not an expense item for February. It is a prepaid expense. Prepaid expenses, which is an asset account statement of financial position, will increase my assets. It will be a debit with a VAT exclusive amount of 10,000 Rand. I can claim VAT. So that can either be an increase of assets or a decrease in liabilities. Both of them would have been marked correctly. It's a debit against the VAT account. Either a decrease in assets or increase in assets. And then bank, I've paid 11,400, so it is a credit against my bank account statement of financial position for the full amount of 11,400. Dumpy has a loan from Babsa Bank for an amount of 100,000. Interest is payable on the last day of every month. The interest rate applicable on the loan is 9.5% per annum simple interest. On 31 January, Dumpy paid the interest due to the bank. So what is our interest? 100,000 times 9.5%, and this is only for 1 month, so times 1 divided by 12, 792 Rand. So interest expense, which is an expense account statement of profit or loss debit, will reduce equity with a 792 Rand, and bank, it was paid, statement of financial position, will reduce our assets with 792 Rand. On 31 January, 820 Rand of stationery bought on 31 December 2016, the previous month, was still on hand, though the initial expense was 3,900, but we have accounted for that in December. So at the end of January, there's still 820 Rand of those stationery left. So we want to create an inventory account, statement of financial position, with the inventory on hand of 820. So it's a debit. Where's the counter leg? The counter leg is going to be against the stationery expense account in the statement of profit or loss. We're going to credit that account, so that will be an increase of equity of 820 Rand.